All right, traders. Next on deck is Indrani Day. She's the head of global investment research at FTSE Russell. With Indrani, we're going to go over an overview of the Russell US indexes in the past 12 months. A lot to cover there. Industry returns highlight several themes that Indrani is going to go over, and we're going to discuss the correlation between economic growth and size index breakpoints. Indrani, welcome back to the show.
Thanks, Anthony. Always good to be back on the show.
It's great to have you. It's our annual show about the Russell Recon. And, I don't like to pull favorites, but this is really always one of my most favorite segments that we do because we really talk about what's happening within the sectors within it. So we're going to get a macro and just, overview of what's going on inside the Russell Recon. So Indrani, take us through it.
Thanks. So, why do we look at the last 12 months? It's essentially because the Russell indices have an annual reconstitution process. So it's meant to pick up what has happened in the markets in the last 12 months. So everything that I'm talking about is about the 12 months ending April 30th, 2024. And because we are not an investment advisor, this is just for educational purposes. The basic macro backdrop, there are two stories going on. One is growth is slowing, but the US growth is much stronger than the rest of the world. And you see that in the two charts. On the right-hand side is what you are seeing about the expectations for the 2024 growth. What was it in December and what is it in April? And you see that it has trended down for pretty much all the major economies. And on the left-hand side, you see what was the growth in the last 3 quarters, like third quarter of 2023, fourth quarter of 2023, and the first quarter of 2024. And you see that each subsequent quarter has been lower than the one before. So that's the slowing growth story. But if you see the absolute numbers, see how high the bars are for the United States compared to the rest of the world, the US is simply having growth much in excess of the rest of the world. Coming to the other theme that the market has really been concentrating on, the inflation story. We all know that the last leg of disinflation is proving to be quite hard. But what is even more important to consider, because the Fed always says expectations are very important because inflation tends to be self-reinforcing. This is the thing that we really need to keep a note on, that break-even inflation, the expectations about inflation are above 2%, and some of those expectations might have gone up a little bit. So that is something to be very cognizant about. And the other thing is, the Fed itself, its policy rates, it's been the same policy rate since about last July. But yields have gone up, they have gone down, they have gone back up. The yield curve at the end of April 2024 was almost where it was at the end of October 2023, because all the drop that we saw in Q4 has been erased in 2024. So, at this point, it's all about the expectations, the uncertainty, what people are thinking about the future, not what the Fed is actually doing. And I think that's been a very important characteristics of the market. Now, moving from the macro backdrop to what is actually happening in equity markets, just like US economic growth is far in excess in most parts of the world, we are seeing the same thing in equity returns, that the Russell 1000, the purple line, rebased from a year back, Russell 1000 returns have been far ahead of the oil world in the last 12 months. But this last 12 months has certain important themes. If you look at the segments of the US equity market between the large and the small, the value and the growth within the large and small, the consistent story is large cap growth. The returns of the large cap growth at almost 32 percentage points, it's far in excess of the other parts of the US equity market. So large cap growth was a clear winner in the last 12 months. But this last 12 months, instead of looking at one number, it's kind of interesting to see it on a time series graph, because it's almost as if the last 12 months have had 4 subsegments. Starting early April, that was well into the period when the AI rally was really on and large cap growth was doing very well. Then we had a general pullback in the market when the Russell 2000 sold off more than the large cap Russell 1000. And then once the market became convinced that the Fed is not going to increase rates anymore, there was a strong catch-up rally by the small caps. And November and December, what you see in that circle, small caps really rallied strongly. And again, as this year, 2024 has begun, it's again been the rally of the large cap growth. So the last 12 months really has separate segments almost in terms of the nature of the market underneath. Now, coming a little bit into the industries, and these are the 12 ICD industries, technology was by far the best performing industry. And I might want to point out that tech being the best performing industry, this was true both in the large cap Russell 1000 and in the small cap Russell 2000. But what is important is how each of these indices are exposed to technology, meaning the weight in technology of the Russell large cap, it's almost 33%. Almost 1/3 of the large cap index is technology. In the small cap, it's a far smaller, just around 14 percentage points. So that exposure to the tech industry is very different across large and small. And if you look at the tech concentration in the Russell 1000 growth, it's really strong. More than 50% of the index, 53% to be precise, of the Russell 1000 growth comes from technology. So if you are in Russell 1000 growth, you're very heavily exposed to the technology story in the United States. Now, where are the markets right now? I mean, on the left, you see the analyst revisions. This is the revisions in earnings, which is really a earnings momentum story. And you see that the earnings momentum is slightly negative for the Russell 2000, the small caps, and neutral to slightly positive for the large caps. And on the right-hand side, you see the 12-month forward PE for the Russell 1000 and 2000. And we see that a lot of the market returns have really been because of the valuation re-rating. The forward PEs for both large cap and small cap have moved up, particularly since the rally that started November. And now if we step back and say, indices are a representation of the market, the Russell indices are the US equity representation. So how closely do the Russell US equity indices track the underlying US economy? Now, the logic of this graph is it's capturing the GDP growth rate in the US, and the gray line is the change in the breakpoint between the Russell 1000 and the 2000. And the intuition is if GDP growth in the US is stronger, companies grow stronger and larger, and then the breakpoint between the Russell 1000 and the Russell 2000 should move accordingly. And as the graph showed, it is indeed true. The breakpoint between large and small closely tracks the GDP growth in the United States. And another interesting point I might point out is the Russell index methodology is constantly being changed to kind of better reflect the underlying US economy. And we see that in the correlation numbers, if you break it into different time periods, the correlation over the entire time period since 1985 is a strong 52%. But in recent time periods, post 2000, it's been 68%. Post the GFC, it's 71%. So the Russell indices are a representation of the underlying US economy because it closely tracks the breakpoint, closely tracks the underlying US GDP growth.
The only real question I have for you is because I'm trading the Russell on a consistent basis, and I'm always looking at what's happening in rates. You can go back and track what happened last November. Basically, the Fed said, it's not necessarily that they were getting ready to cut, but they were done hiking. Like basically they had inflation under control, and you just saw the Russell have, I think, one of the best months I think it ever had in the history of the Russell, which is saying a lot. And I don't know the exact numbers, but I know it was a massive move. Then you get into this year, economy strong, and we continue to see strong numbers, which is why the Fed's hesitation really here to cut rates. You have the Russell Recon going on. The economy, if it stays strong, but yet the Fed maybe doesn't cut rates this year, because which is seeming like that's more and more the possibility. Does this Russell Recon, does it start to break away from that trend that rates are just stuck here? Maybe they stay relatively high, and you could potentially see, the Russell starting to break out to the upside, maybe with the rest of the indexes? Or how do you foresee the rest of the year happening if rates just kind of just stay exactly where they are?
Since we are not an investment advisor, I will not forecast, but I'll point out the trends that you mentioned. Rates, inflation, is it under control? What is the Fed going to do? And accordingly, where rates are expected to be has really been a driver of the markets for quite some time. And in the environment that we are in, probably rate expectations will continue to drive the economy. So there are two things to keep in mind. The Russell 2000, the small cap, is a much more domestic oriented index, excuse me. So Russell 2000 is to that extent even more exposed to the rate story, which is why, November and December of last year, when there was very strong expectation that the Fed is done with rate hikes and it's going to be cut, and there were quite a few rate cuts priced into the markets, that's when the Russell 2000 really did so well that it really strongly outperformed the Russell 1000. Whereas now, when growth is coming in much weaker and the inflation is still not totally under control, the expectation is of fewer cuts and cuts coming in later, we again see the story that large caps, which are, they have stronger balance sheets, they have more international exposure. So they are again in this uncertain environment. We again have the large caps pulling ahead of the small caps, and it's again becoming a large cap growth story.
Yeah, that's well put. I think it just comes down to if we know what the Fed is really going to do, these businesses can start operating. I think that the whole question right now is people aren't even sure if they maybe are even potentially hiking. But in the scheme of things, Indrani, what's a quarter point either way? I think that the market's starting to see through that. It'll be very interesting to see how the rest of this year goes. Indrani, thank you again so much for coming on. Like I said, every year I learn so much from you, and I really appreciate your time.
Thank you so much.